In early 2021, prompted by the renegade activism of Reddit users, a fierce battle erupted between American retail investors and Wall Street hedge funds with small-cap stocks. At the center of the storm were the brick-and-mortar entertainment companies GameStop and AMC, and the target of the storm, Wall Street funds, in particular, Melvin Capital, which was utterly routed by retail investors, but unexpectedly revived due to a $2.75 billion investment from two top firms, Stephen Cohen's Point72 and Citadel, under the leadership of Kenneth Griffin. Why did this pair of billionaire investors plow nearly $3 billion into Melvin? Was this a classic bailout, or are there other incentives lurking below the surface? How did Gabriel Plotkin, the CEO of the Melvin Fund, cement his firm's reputation for lucrative investments prior to the short-selling saga? Will Melvin Capital stand up again after the GameStop debacle, or was this the harbinger of a long, painful decline? Hello and welcome to the HedgeBee Explains series. In this series, we will dive deep into the strategies of the most legendary funds on Wall Street and decode their secrets to success. Today's focus is Melvin Capital, a hedge fund that survived near ruin due to its savvy partnerships and enlightened leadership. Prior to the notorious GameStop drama, which took the investing world by storm, Melvin Capital was one of Wall Street's most vaunted hedge funds. Melvin Capital presents a slim public profile. On its website, there's only one page, displaying the firm's name and its Madison Avenue corporate address. In italicized lettering, there's a quotation that reads, "The firm uses a bottom-up, fundamental, research-driven process to identify investments, employing a long-short equity strategy. No team introduction, no contact information, and no big man's endorsement. Just a focus on the work." Melvin Capital has thrived on a powerful adherence to these basic investing strategies etched onto its website. Who is the 42-year-old Gabriel Plotkin, the firm's founder and the person responsible for growing Melvin Capital into a Wall Street juggernaut? Plotkin's origins were humble. He grew up in a middle-class family in Maine before attending Northwestern University and entering the world of finance at Ken Griffin's hedge fund, Citadel, LLC. After a year, he shifted over to North Sound Capital in Connecticut as a consumer stock analyst. But in 2006, he accepted a job at Stephen Cohen's fund, SAC Capital Advisors, where his career really began to take off. Within 5 years, he was managing more than $1 billion in consumer stock. His talent deeply impressed Stephen Cohen, and Plotkin quickly became one of his most trusted protégés. As the manager of SAC Capital's largest investment portfolio, Plotkin quickly became an emerging star on Wall Street. In an interview with Bloomberg News, a former colleague commented how Plotkin was legendary within SAC for his rigorous business research and fearsome analytical skills. He used detailed models to study companies meticulously, spotting flaws and opportunities from cash flow to product demand. Unlike many analysts who lazily relied on reports and market information provided by brokers, Plotkin was among the earliest hedge fund investors to unearth insights from credit card data, which at the time represented a relatively untapped data source. Plotkin developed a reputation as a confident adventurer, holding a large number of long and short positions that brought consistent and lucrative returns. This is where he developed the investment strategy he would eventually bring to Melvin Capital. In 2013, SAC faced legal trouble. After a 6-year fight with the SEC's insider trading team, Stephen Cohen pled guilty to insider trading and paid a record fine of $1.8 billion in one of the largest criminal cases ever brought against a hedge fund. Cohen was prohibited from managing outside money for 2 years as part of the settlement reached in the civil case over his accountability for the scandal. The hit TV show Billions is based, in part, on this case. So prohibited from managing money that wasn't his own, Cohen rebranded and launched a family office called Point72. However, when his 2-year probation elapsed, the firm began accepting external capital. One of its first investments was a $200 million infusion into Melvin Capital, the new hedge fund set up in 2014 by Cohen's protege, Gabriel Plotkin, who had avoided being implicated in Cohen's insider trading scandal. Before the spring of 2021, Melvin Capital's performance was obvious to all, except for a small dip in 2018. It posted an annual return rate well above 40% between 2015 and 2019, increasing to a return of 53% in the year 2020. Plotkin relies on the potent cocktail of skills he developed as a maverick analyst at SAC, leveraging powerful business research capabilities, betting boldly, and earning that alpha that outperforms the market. Melvin Capital had found a particular niche in short selling. In the first year after its establishment, 70% of its profits were generated from short positions. The early successes of Melvin Capital exemplify how personal relationships rule many of Wall Street's most lucrative firms. By 2020, just a few years after establishing Melvin Capital, Gabriel Plotkin had transformed the $200 million in seed capital invested by his former boss and mentor, Stephen Cohen, into $1 billion in assets under management. Despite $500 million in losses during the first half of 2021 in the wake of the GameStop saga, Melvin Capital was able to stand on a strong reputation and continue attracting large capital investments. During the most critical moments of the tussle between hedge funds and retail investors during the GameStop spectacle, when Melvin Capital was hemorrhaging funds, over the course of just a few hours, Plotkin granted non-controlling earning shares for 3 years to his allies at the fund's .72 and the Citadel, in return for being floated $2.75 billion in order to avoid catastrophic losses. This infusion was especially timely. It reduced Melvin Capital's demand and eased the pressure of margin calls. After dropping 55% in January, Melvin's performance rebounded by 22% in February of this year. The fund continued to pick up momentum, attracting $250 million in new financing, which strongly indicated that the holders of Wall Street Capital still trusted Plotkin and saw his firm as a lucrative vehicle to enter the market. By July 1st, the scale of funds managed by Melvin Capital had climbed back up to the $10 billion threshold. Melvin supporters remarked how they doubled down on Plotkin, throwing him a lifeline because they firmly believed in his trading acumen, unimpeachable reputation, and dedication to his family and employees. Plotkin is a firm believer in the old adage, "What doesn't kill me will make me stronger," and is hungry to redeem his failure from earlier this year. Drawing on his experience as a talented analyst, he claims he has learned from his mistakes. Moving forward, he says he will avoid crowded short positions, exert more control over the positions of each company, and leverage his data team to track social media, and build a sort of early warning system to determine when certain stocks are generating undue excitement due to the activities of renegade investors on communities like Reddit. In addition, to avoid potential damage wrought by these dynamics, Melvin Capital has ceased using put options when making quarterly submissions to the SEC. So, what are the ingredients that led to Melvin Capital's success and resilience? It is led by a team that prioritizes bold and innovative business research, is endorsed by strong capital suppliers, and is deeply trusted by some of the biggest players in Wall Street. Can Plotkin still generate amazing returns without reliance on large short positions? We'll leave this question to Melvin Capital, and we'll return to it at the end of this year. Meanwhile, keep following the HedgeBee Explains series, and let's continue to uncover the mysteries of Wall Street's biggest hedge funds.